Hi everybody, Marco Carbajo here from businesscreditblogger.com. Today's video we're going to talk about balance transfer to business credit cards. Should you balance transfer credit card debt that you have on personal cards to your business credit card? So by the end of this video you're going to learn 5 specific reasons why it's so important to consider transferring your business-related expenses that you have on credit cards to business credit cards that only report to the business credit reporting agencies. So remember, the way this is going to work though when it comes to balance transfers is it's only effective if you use business credit cards that only report to the business credit reporting agencies. Through our business credit card program, we set you up with about 4 to 5 business credit cards in your company's name that only report your payment activity, your debt on those cards to business credit reporting agencies, not personal credit. So let's get started on why you should balance transfer to business credit cards. The first, of course, is separation between your personal and business expenses. If you're using personal credit cards right now for your business, you're making purchases on personal credit cards, whether it's even paying for gas in your car to travel to an appointment for business, whatever charges you're putting on your personal credit cards should already be moved over to business credit cards, because that separation allows you to separate your expenses. It allows you to not commingle your credit and your funding. It makes it a lot easier during tax time. So that separation is very important. When you have a business credit card issued in the company's name, then all of your business-related expenses are on that particular card, not your personal credit card. Your personal credit card should be used for personal expenses. So that separation is key. That's number one. And there's no better way to separate your personal credit from your business credit than to use a business credit card. Now, reason number 2 is it improves your per-card utilization ratio. Now, what does that mean? As you know, when you're looking at credit scores such as FICO, etc., your credit utilization is a major factor. It's actually 30% of your score is based on credit utilization. So your per card utilization means the amount of credit that you have available compared to the amount of debt that you have on that card. So for example, if you have a $5,000 personal credit card and you have a current balance of $2,500, then you have a 50% per card utilization ratio on that specific card. So ideally you want to be under 30%. The lower ratio you have on your personal credit cards, the greater the impact it's going to have on your score. It's going to show lenders that you know how to manage your finances responsibly, and also that you don't carry a lot of debt. So let's just backtrack on how this balance transfer to business credit card works. Let's say you have a personal credit card right now that you have a $5,000 credit limit on it, and you have $2,500 that you owe, and those are from business purchases, business expenses, or business-related expenses that you put on that personal credit card. So basically you have $2,500 of business debt on a personal credit card that shows you have 50% utilization ratio on that card, per card ratio. Well, let's say you open up a business credit card in the company's name that only reports to business credit reporting agencies. And let's say this business credit card has also a $5,000 credit limit. Of course, it's going to usually be more, but let's just say $5,000 to make it easy to understand. What you're going to do is you're going to take the balance that you owe on that personal credit card for $2,500, because that's business expenses, and transfer that balance transfer over to the business credit card. Okay, because business credit cards also do balance transfers. So you're moving the debt. You're not paying it off. You're moving one debt, the personal credit card debt, that's business-related expenses, onto a business credit card. Okay? Now, typically remember that banks, card issuers will charge anywhere from 1 to 3% a balance transfer fee. Okay? But what happens is now that $2,500 is moved over now onto the business credit card, and that $2,500 now is eliminated on your personal credit card. So now you have $5,000 in available credit on the personal credit card. So your per card utilization ratio on that card now went from 50% down to 0%. Okay? So obviously you know that's going to improve your utilization ratio on that specific card. It's also going to improve your overall utilization ratio, which we're going to talk about in a second. But now the business credit card has a new $2,500 limit, Okay, but that that's only reporting to the business credit agency. So now you literally wiped off $2,500 of business related debt on your personal credit reports, and now they're reporting to the business credit reports, which is where they should be. Okay, so that's another major reason why you should balance transfer to business credit cards. I'd like to say business credit reporting cards. Now let's talk about the third reason, is it improves your overall credit utilization ratio. Now what does that mean? You have your per card utilization ratio and you have your overall utilization ratio, your credit utilization ratio. Now keep in mind, your credit utilization is based on revolving credit. It doesn't include installment debts or mortgages. It's just revolving credit. That's what the scoring models pay attention to. So what is revolving credit? That's like credit cards. That's like personal bank lines of credit, etc. So when you're moving, let's say you have multiple debts on, let's say you have two personal credit cards, and both of those personal credit cards have $5,000 credit limits, and you have $2,500 balance on one, $2,500 balance on the second card. Okay, so let's say that combined total is you have $10,000 available credit between those two cards, but you owe $5,000 total in debt. So your overall utilization is 50%. Okay, so that's the difference between per card utilization and overall. The scoring models look at both. Okay, so your overall credit utilization, if you did the same strategy that we talked about in the per card utilization and move both of those business related debts from the personal onto business credit cards, then your overall utilization is also going to improve. So you literally can drop that 50% overall utilization ratio down to 0%. So imagine what that's going to do for your credit scores. Okay, so that's the difference. That's the third reason. The fourth reason is, of course, this is going to save you money. Now, what do I mean by that? Well, let's take the same example. Let's say on those personal credit cards, the $2,500 in business-related debt you have on personal credit cards, let's say you're paying a 19% interest rate with those cards. You're paying 19% annual interest rate on that debt. Well, with the business credit cards we set you up with through our program, they come with a 0% introductory offer. And that 0% period is going to range anywhere from 6 months to as high as even 15 months or longer, depending on the card issuer. So when you transfer that debt over to a business credit card where you have a 0% introductory rate offer, imagine you're now going from paying 19%, let's say, on a $2,500, even $5,000 in credit card debt, down to 0% for, let's say, 12 months. Let's say that's the 0% offer you have with that particular card. So all that interest you're being charged is now being saved, and you can actually use that to pay down the debt even faster. Okay, so that's how you're going to save money, is moving from high credit card debt down to maybe a 0% or even a lower interest rate on business credit cards. The next benefit, let's talk about the fourth benefit. The other major benefit that this also does is it also builds your business credit, because these particular business credit cards only report to the business credit reporting agency. So by setting up a business credit cards, and let's say you're moving over that debt over, doing the balance transfer to business credit cards, now the payments you make on those business credit cards gets reported to the business credit reporting agencies. So this allows you as a business owner to build your business credit worthiness. Your payment activity is going to be reported. And this will also generate a credit rating for your business if you have about 4 to 5 business credit cards through our program. So this is some of the really unique aspects of the business credit card program. Now the other final thing, and this is actually a sixth one, I said there was 5, there's actually 6, is it improves your personal credit scores. That's a huge factor, okay? When you do a balance transfer to business credit cards, and we take the same examples we talked about earlier, and you're moving, let's say you have $10,000 available credit on personal credit cards, and you're moving over, and you have $5,000 in business-related expenses and credit card debt. If you move over that $5,000 over to business credit cards that only report to business credit reporting agencies, if you drop your utilization ratio from 50% on the per card utilization ratio and the overall credit utilization ratio in this example, imagine you're going from 50% down to 0%. you could see a major increase on your personal credit scores, major boost. Okay, so these are all the benefits of doing balance transfer to business credit cards. But remember, for this to be effective, is the debt you transfer on your personal credit cards or personal lines of credit must be business related expenses. And secondly, is the business credit cards you transfer those balances to have to be business credit reporting cards. Because if you just transfer them to business credit cards, yes, you're getting that separation, but if you're getting a business credit card, let's say you just open up online, most of the business credit cards in the marketplace report to your personal credit. Okay, so that's not going to improve your utilization ratio. It's not going to improve your overall utilization ratio because you're basically just moving debt around, but you're still impacting those debts are still reporting on your personal credit. So with that, remember, a balance transfer to business credit cards is only as effective as, of course, the types of cards you're using to transfer those balances to. You have to make sure they're business-related expenses. If you want to pre-qualify for a business credit card program, be sure to check out businesscreditbuilders.org and look up at the lines of credit. We'll show you how to pre-qualify. You need to have at least a 680 or higher FICO score. That's the minimum requirements, but the higher the score, the better. This is the stated income program, so there's no financials, no tax returns, no collateral. They're completely unsecured. And the process itself takes about 14 to 20 days for you to get 4 to 5 business credit cards issued in the business's name that only report to the business credit agencies. So with that, be sure to check the like button if you really like this video. So click the subscribe button because we're always putting out videos like this on a weekly basis to help you as a business owner or as a real estate investor to separate your personal business credit, how to maximize your funding potential so you can grow your business. Make it a great day. We'll talk to you real soon.